Good morning, and thank you for joining this morning's webinar on year-end tax planning. Today's presenters are Brian Wallace and Lou Young from Witham, a longtime supporter of NJCAR and all New Jersey dealers. We were expecting to have Phil Kraft, also from Witham, but he had an unavoidable situation and isn't able to join us today. But we do expect to have Grayson Hannigan, NJCAR's Director of Legal and Regulatory Affairs, for a brief period of time. He's not going to be on the call when we wrap up the webinar. So if you have any questions for Grayson, please contact him via email. Brian and Lou are going to discuss tax planning strategies, recent changes, and upcoming changes in tax law, proposed new legislation that could impact dealers, and a variety of other hot topic issues that dealers should be aware of as they close out 2021 and get ready for 2022. Before we begin, just a few quick housekeeping details. On the right-hand side of your screen is a control panel. Take particular note of the Questions tab. During the call, all participants will be muted. If you have a question during the presentation, we ask that you write it down. You can submit your question in the Questions tab near the end of the webinar if it hasn't already been answered. Brian and Lou are going to hit on a lot of things today, so your question may very well be answered. But if it isn't, we'll ask people to submit them towards the end, and we'll do some Q&A. So now I'd like to turn things over to Brian and Lou.
Thanks a lot, Brian. Welcome, everybody. Welcome, Grayson. I'm glad you could join us for a little bit today. We are going to cover some of the year-end tax planning and accounting updates where we stand today in December. Brian Wallace, as you know, is one of the leading automotive tax advisors in the country. We call on Brian for any questions that we have in the automotive tax realm. You can reach out to either of us anytime if you have questions or you have anything that comes up in the automotive accounting area. Please don't hesitate to reach out to us. And as Brian pointed out, we want to cover some things today, including LIFO, some of the recent legislation, some of the sunsetting provisions in the TCJA that we need to think about, some inventory issues, the New Jersey bait tax, which we should all be familiar with at this point, and then some of the electric charging infrastructure issues that are out there today in New Jersey and with the federal credits. So when we first started talking about this a few weeks ago, Jim Appleton was really interested to hear what we had to say for LIFO. We're going to talk about LIFO first. Unfortunately, what we're seeing here is a perfect storm as far as profits and the situation that we're in, where LIFO recapture would be added to these profits in 2021. So we are concerned about this. We're seeing some inventory levels at record lows. This should come as no surprise to anyone, but we are describing it now as the perfect storm. So how did we get to this perfect storm? Obviously, there have been some shortages that have affected the production of vehicles. We see approximately 40% of our dealers are using the LIFO method. So the combination of the shortage, the inventory shortage, and the fact that you've been on LIFO for a number of years is adding up to this problem. Obviously, if you've been on LIFO for a long period of time, you could see the effect of this even to a greater extent. So, this is something that we talked about last year, but it's something that we are definitely concerned about this year. So again, this is income that would be coming in on a phantom basis, additional income above and beyond any significant net income that you have this year. So it does come at a point when, even though dealers are in a good position from a cash standpoint, they're not looking forward to the additional tax liability. So Brian, why don't you take us through some of the situations that we're seeing now, and what we can expect to see as far as the go forward.
Sure, thanks, Lou. So here's a couple examples of what we've seen just in our travels throughout the end of the year tax planning. This situation, you have a dealer at the end of last year, $20 million in new car inventory. They had $2.5 million LIFO reserve. And we went in end of September, took a look to see what they had. That $20 million of inventory is now down to $8.6 million. So that represents a 57% reduction in their inventory. We ran a LIFO calculation based on where they were, and based on that, we're looking at a $1.4 million recapture. So, in this case, it's actually relatively close to being pro rata with the reduction in the value of the inventory. So we see a 57% reduction in inventory, leading to a 56% recapture, and the estimated tax liability based on that $1.4 million recapture number is more than $500,000. So it's not insignificant. The next situation, if we flip to the next slide, Lou, relatively similar. So about a $12 million in new car inventory at the end of last year. Similar LIFO reserve, $2.5 million. I guess you can compare that to the previous slide where we had a $20 million in new car inventory and a $2.5 million reserve. These situations really, the longer you're on LIFO, the bigger your reserve generally gets. So this is a situation where this dealer's been on LIFO for a longer period of time. Went out there in November, took a look at what they had, $6 million in new inventory, so it's about half. But in this case, $550,000 LIFO recapture. So even though they have the same LIFO reserve and had a similar reduction in inventory, they are only recapturing 22%. So it's not a similar percentage recapture. So I think kind of the lesson here is that you have to run the calculations. A simple back of the envelope, my inventory is down 50%. I'm going to get 50% of my LIFO back in as income. Doesn't work in this case. You have to factor in all the different layers, and that's where the LIFO software comes in and makes us all look a little bit smarter than we actually are, because I can't imagine anybody doing these calculations by hand. Why don't we hop to the next slide? I'll talk about what we're looking at for options for mitigation. So what can we do about this? Before I go crazy on what can we do, we have to ask the question, do we even really want to do anything? So LIFO is something that we go on, and the plan and the idea behind LIFO is this is a long-term tax deferral strategy. So over the course of your LIFO life, you've been accumulating this reserve and deferring paying income taxes at what were, in some cases, significantly higher tax rates. We're in a very low tax rate environment right now. Maximum federal effective tax rate on flow-through income, 29.6%. If you happen to be a C corporation, you're at 21%. Unlikely we'll be seeing tax rates like this in the future. So in some cases, it's done what it was intended to do. So that's kind of the good news portion of this webinar. Might be probably the only good news piece, but so let's just get back into talking about some options for mitigation. First thing you want to do, and you always want to do this at the end of the year, but this year it's even more important, is make sure you're accounting for all of your in-transit vehicles. So take a look at your wholesale statement, make sure that anything that's on your floor plan is in inventory, and pull that stuff in, because anything you can do to increase your year-end inventory is going to reduce the amount of LIFO recapture. Acquire more inventory. I put good luck. I don't think it's out there. I'm not sure how you're going to acquire more inventory, but I had to put it on there just as a potential for mitigation. Another option that's on here. So, and I've heard this talked about a little bit. This is an accounting method change. So changing from this specific identification LIFO method that we have most of our dealers on, that, you know, new cars, new trucks, they all have their separate pools, and used cars are treated differently and parts aren't part of it. This inventory price index computation method it's a pooled LIFO method that pulls in your used inventory, it pulls in your parts, it pulls in everything. And the idea behind that is that maybe by increasing inventory in other areas, so parts or used or anything like that, you can kind of spread out the pain a little bit and mitigate the amount of recapture that you get stuck with. I'm not completely sold on it. You know, one of the reasons is most dealers are already booking a reserve against your used vehicle inventory, right? So they're tracked at lower of cost or market. So at the end of the year, you're going in and you're taking a reserve against your used to bring those down to, you know, the GALF's value or something like that. So you've already got a reserve booked against it. You flip over to this new method, you're pulling that reserve in immediately. So I'm not sure that it's going to solve everybody's problem, but shouldn't be completely ignored. Probably something you want to look at, or at least have a conversation with your accountant about whether it does make sense. Section 473, I think that's the big one. I mean, it's been in the headlines. Hopefully you've all written letters to your congressman, your local congressman, and told them to start pushing for this. 473. This is a provision in the Internal Revenue Code that allows for relief in situations like we're seeing right now, right? And when there's this, quote, qualified inventory interruption, where you're unable to, you're basically depleting all your prior LIFO layers inadvertently, right? It's out of your control. It's not like you've made a conscious decision to carry less inventory. This is something that it's a supply chain issue. And so if you read through kind of the guidance on this and does this appear to qualify under 473, you would read it and you would say, you know what, this absolutely qualifies under 473. The problem we have is that for this to qualify under 473, Treasury needs to come out and actually publish in the Federal Register that this is a qualified inventory interruption. So it's not a position that your accountant can take on your tax return that this situation meets the exceptions under 473. We need guidance. We need a firm opinion from Treasury that says, yes, this is a qualified inventory interruption. You know, auto dealers that are on LIFO can claim relief under 473. And that sort of allows you to it gives you 3 years basically to replenish your inventory levels. So your reserve kind of sits where it is until you get to that year 3 point, and then you pick back up and recalculate your reserve. It just is, you know, it's a timing difference, right? And that's all we're kind of asking for in this. The problem is, like I said, we need Treasury to back us on this, and I'm just not 100% sure. I mean, 4 or 5 months ago, I would have said there's a 5% likelihood. Maybe I'm up to 15%, maybe 10%, but I think it's getting a little bit more traction. The problem is that, you know, it's hard for them to feel bad for car dealers because, you know, as Lou pointed out in some of the earlier slides, this whole perfect storm, you know, higher grosses than we've ever seen. Lots of cash in the bank. Everybody got PPP money, so, you know, free money from the government. So high cash balances, high profits. You know, dealerships don't appear to be hurting, and that's, you know, that would, if we were hurting, that would go a long way to getting some sort of help under 473. But I think it's unlikely, but it's still an option that's out there. I wouldn't count on it.
So to Brian's point, certainly NADA has been working hard on this. 3 months ago, I would agree this probably had a 5% chance of passing. Obviously, you have to meet the boycott or some type of foreign trade interruption clause in this provision. And again, NADA has been working on this tirelessly for the last few months. Recently, as we've all seen, certain senators on a bipartisan basis have gotten involved in terms of lobbying Treasury to allow for this suspension, I think is the right word. I don't know if there's going to be any legislation, but again, in the recent few weeks, we have seen an uptick in the lobbying coming from Congress. So while we're not more hopeful, we're seeing some movement here. I don't know if anything will happen, but stay tuned. NADA and NJCAR will continue to monitor this and let you know if something does happen. So again, Brian, at this point, what's the best choice of bad options?
Yeah, I mean, and that's exactly right. So the options that are out there, like I said, you can just take the hit, right? So take the hit, move on, stay on LIFO, recognize that 2022 is going to be a big layer, right? We're going to replenish some of our inventory in 2022 and 2023. Those are layers that'll be around for a while, and then 15, 20 years, there'll be some significant value to having still been on LIFO, but it comes with a cost, right? So it comes with an immediate tax hit, but also in the lowest tax rate environment we've been in a long time. So the other option, you can file a change in accounting, Form 3115, elect to go off LIFO, and you can string it out over 4 years. So you pick up the recapture over a 4-year period. The downside to that is you're subject to the tax rates that are in effect in the following 3 years. So in this example here, we have a dealer with a $2.5 million LIFO reserve at the end of 2020. So we did a calculation. Looks like they're going to have a $1.4 million pickup or reduction in their LIFO reserve. They're going to pick that up as income. If they do nothing and just take the hit, then we're looking at federal taxes of more than $414,000. If they decided to elect off LIFO in 2021, so this goes back to you basically are taking your $2.5 million LIFO reserve, your beginning LIFO reserve, and you are taking that in over 4 years. So 25% of it, or $625,000, that comes in 2021. Get the benefit of the lower tax rate. So $185,000 versus $414. That sounds great for 2021. But then look at what happens for 2022 through 2024. You're subject to likely higher tax rates. We just threw a 3% increase on there. We'll get into a little bit later what some of the likely increases that we're going to see are, but this, just for purposes of this, you could see that 185 turns into 203, 750 for the next 3 years. Now you're at almost $800,000 of tax over a 4-year period. Whereas if you had just taken the hit on the 414, you very likely are going to start rebuilding your LIFO layers and not have recapture in 2022 or subsequent years. So, that's one option. I think we flip to the next slide. There's another, example here, and this is sort of blending the two options. So if you really have a problem with LIFO, and I'm not sure why you would have a real problem with LIFO, because it really is kind of a wonderful thing on a deferral perspective. But some dealers, I guess, lose sleep over this lingering tax liability, right? So it's a future tax obligation that you're going to have to pay one day. And so some people don't like to have that on there. And now maybe this is an opportunity to actually get off of LIFO and not have to worry about it going forward. Whether you're considering transitioning the dealership to the next generation, you want to, sell it to your kids or gift it to your kids or do something like to that, and you don't want to burden them with this additional tax on LIFO. maybe now's the time to get off. You know, you pick up the LIFO, pay the tax on it, it reduces the value of your estate, it goes to them. You know, they don't have that future tax burden. So the column over on the right, elect off LIFO in 2021, that's what we saw on the previous slide. The one on the left is, you know, take the hit in 2021 and then elect off in 2022. So that remainder you pick up over, you know, 2022 to 25. So, and you know, you do get the tax rate benefit from year one. So there is a bit of a savings there by doing it this way. These are just some final points on LIFO. Yeah, I think I covered all this, so I'm not even going to reread them. We could probably hop through that.
And again, the age of your LIFO reserve really makes a huge difference in what type of recapture that we're seeing. So that's something that you'll want to look at and assess before you make any of these decisions. Brian?
Sorry about that. I'm muted. I thought you were going to handle this, but I'll talk about this. So with the reduction in inventory that we're seeing, there are some other items that other inventory deferrals or reserves or adjustments that are going to be impacted by this. 263A, inventory capitalization, UNICAP, whatever your accountant calls it. This is just a requirement that most dealers have to capitalize a certain portion of their administrative costs into inventory. Usually minimal, but with a reduction in inventory, this will cause a reduction in your UNICAP or 263A calc, so you get a little bit of a benefit there. Not significant in my opinion, but still I think worth mentioning. I touched on used car write-down. So this is how most dealers account for their used car inventory. It's just an adjustment to write down the ending value of your used car inventory to market value, you know, using a Gallups or other published source. You know, with inflated, I mean, I guess I'm kind of seeing it all over the place, but for the most part, I'm seeing significant increases in used car inventories on dealerships. So, you know, with the increase in used car inventories, very likely you're going to see a much bigger used car reserve. Trade discount. So I'm going to make the assumption that everybody's doing the trade discount method. It is sort of required by the Internal Revenue Code, but what this is just a, this is how you account for things like floor plan credits and stuff like that that are really a reduction in the purchase price of the vehicle. I know that previously there was a trend, I think, to kind of ignore this and just let this run through P&L and not pull this into inventory. But this is really a reduction in the cost of your inventory. And by running it through the P&L, what you're doing is you're inflating your income, right? So if you could have a lower value on your inventory, then you would do that because that results in lower taxable income. So most people should be following the trade discount method. Unfortunately, with the lower value in inventory, if you've been following this, you're going to have a lower trade discount adjustment. So that's another kind of a recapture item similar to your similar to LIFO. Not too much to talk about here on parts adjustments. Just make sure that you are accounting for them and book into what the market value on your parts inventory is. Lou, you want to talk about recent legislation? I think people are getting tired of me talking, and I'm going to fix my blinds behind me so that I'm not completely washed out.
So we have the $1 trillion infrastructure bill that passed in early November. The only major aspect of that affected dealers was the fact that the ERTC has been removed for the fourth quarter. So the last quarter in 2021 that you can apply for the ERTC is for third quarter. We were not seeing a lot of dealers qualify in 2021. There were a few, but the big the big opportunity is in 2020 for the partial shutdown period that occurred in early summer, late spring. If anybody has not applied for their ERTC yet, they should be looking at that. Obviously, if they had a greater than 50% reduction in their gross receipts in 2020, they should, for any quarter, they should be looking at that as well. And again, if you remember, it's a 20% increase for 20% decrease for 2021. There were other items included in terms of crypto asset reporting, and also there were some long-term extension period of time with modifications of the Superfund excise taxes. Again, the big item for dealers is the ERC credit going away in the fourth quarter. Brian, you want to talk about some of the proposed legislation?
Yeah, definitely. So the infrastructure bill, I mean, that was primarily a spending bill, right? And I think initially they had it all kind of lumped together, and they were going to try to get the one huge bill passed to have tax increases, the spending, all that. And they did split them off with some sort of, I think, side agreement that's saying, you know, yes, we're going to pass the spending bill, but we're also going to pass another bill to raise some revenues. So they're going through this budget reconciliation process. They're trying to get this Build Back Better Act passed. I believe it is with the Senate now. So it kind of came out of the House. It's sitting with the Senate. They don't love it. So it looks like they're working through some potential changes. But the most recent version of the bill that we've seen has a couple of provisions in there, I think, that are worth noting. One that I just think is kind of odd, but it does impact, and I'll talk about a little bit later, the New Jersey bait and the pass-through entity taxes and the salt cap limitation workarounds that all these states are passing. They threw in a provision to just bump up the salt deduction to $80,000. And you know, you would think 80,000 is kind of an arbitrary number. It's actually meaningful in terms of alternative minimum tax for individuals. Once you kind of get up over that $80,000 of state taxes, you know, you end up getting kicked into an alternative minimum tax situation, depending on your level of taxable income. But you know, I think most lower income taxpayers aren't going to have $80,000 of state taxes, so they won't have an AMT issue. And once you get up over that, you know, $400,000 or $500,000, and you start getting into that, you might end up with an AMT issue. This kind of keeps you out of it by capping it at 80,000. There's another one that's somewhat significant. This tax rate surcharge or excise tax, basically just tacking on an additional 5% or 3% to your tax rate if your modified adjusted gross income is over 10 million. And then once it's over 25 million, you're at 3 plus 5, you're at 8%. So that would, you know, that's something that they're proposing to have effective for 2022. So that'll start kicking in next year. Qualified small business stock, not all that significant in the car dealership world, but this is it's a provision under Section 1202 that allows founders of C corporations to avoid paying capital gains tax on the sale of their C Corp shares on an exit. So, you know, we see it a lot in technology and life sciences, companies like that. I've never actually seen it on a dealership, but it's in there. So they're going to basically eliminate that for people with income over a certain level. Can you pop back one, Lou? I think I skipped probably the last and most important one, which is the expansion of the net investment income tax. So net investment income tax. So this is something that's been around for a while. It came about as part of the Affordable Care Act as a way to pay for, you know, national health care, basically, right? So the original net investment income tax and how it currently stands is it's exactly that, tax on your investment income. So interest, dividends, capital gains, and passive income that flows out to you. and it's 3.8% on that income to the extent that your adjusted gross income is over a certain threshold. I think it's 200,000 for individuals and 250 for married couples. The proposal is, okay, but let's just expand that 3.8%. Anybody that makes over a certain dollar amount, we're going to subject all their income to all their flow through income. So in addition to interest, dividends, capital gains, passive income, all of a sudden the ordinary income that's flowing to you from your S Corp or partnership dealership is now subject to an additional 3.8% tax on top of what you're already paying in maximum taxes. So this is significant. This will affect, assuming that this is in the final approved legislation, this will affect pretty much every dealer that's out there, I believe. So it's significant. Have not really come up with a way around it, just because the way it's worded, it really is pretty far-reaching. There's some interesting implications on how that affects a decision of whether to remain a flow-through or potentially flip over to some sort of a C corporation, and whether that ends up being a better model from a tax perspective. I still don't think it does, but it's making it closer and closer every time they raise individual tax rates. Let's check the next slide, see what we got there. More proposed legislation, excess business losses. So this was initially part of Tax Cuts and Jobs Act, supposed to start in 2018. And what an excess business loss is it's flow through income, and it was supposed to limit your business losses to $500,000. And so kind of the way this works is, say you have two S Corp dealerships, you own them 100%. One makes $1 million, the other one loses $1 million, flows to you personally, net zero, that's fine. You can offset those, the $1 million of income, $1 million loss. Same situation, except dealership B loses $2 million. So now what flows to your personal tax return? $1 million of income, $2 million loss, you net them, it's showing $1 million loss. You can only deduct $500,000 of that. The other $500,000 loss gets automatically kicked down to net operating loss, available for use in subsequent years, but you can't offset your other sources of current year income with more than $500,000 of excess business losses. So, like I said, originally this was supposed to be effective for 2018. The CARES Act actually changed that retroactively and suspended this provision of the code. And it is in effect for 2021. So it's not new for 2021. What is new is that, or what's new with this legislation or the proposal is they want to make it permanent, right? Like a lot of the provisions of the Tax Cuts and Jobs Act had kind of expiration dates, and this was another one that was going to expire after 2025. So, this is a provision to make this permanent. Federal Pell Grants, I don't think that's relevant. The business stuff is in here. I think the important, this 15% corporate alternative minimum tax, and while it doesn't affect dealerships, probably is the biggest revenue raiser in this entire bill. It basically is bringing back, in one form or another, the federal corporate alternative minimum tax, and it's large corporations, so 3-year average annual income over $1 billion, so it's significant. Stock buybacks, international tax reform, we could skip those though. Okay, so that's what's pending out there. There are some things that we know that are going to change that are a certainty, right? So as I mentioned, Tax Cuts and Jobs Act, a lot of that stuff, it starts to sunset, goes away. Qualified business income deduction, 2025 is our last year. 2026, it goes away completely. Just for as a reminder, that's the 20% deduction you get on flow through business income, right? So that's what takes our effective federal tax rate from the 37% down to 29.6, right? We get this automatic 20% deduction based on business income that flows out of our dealerships. There's some limitations and stuff, but typically not an issue for a dealership that has employees. But so, like I said, that's going to go away. That's not an immediate problem. That's just something to keep in the back of your mind. We'll probably remind you every year that that's happening. 163J. So this is another Tax Cuts and Jobs Act provision. These are the interest deduction limitations. I'm not sure if people recall, but initially this was a huge problem for dealerships when it was first proposed, right? Because the way 163J initially was worded was you can only deduct interest to the extent it does not exceed 30% of what's called adjusted taxable income. And when I say adjusted taxable income, you just think EBITDA. It's really income before, income, and then you add back your interest and your depreciation and all that stuff. And that was initially a problem for dealerships, and that I think NADA spent some, really good efforts in negotiating and lobbying to get an exception in there for car dealers because of our reliance on floor plan financing. So that this floor plan interest exception came about. The give back on that was an inability to use bonus depreciation if you had to rely on the floor plan interest exception. But so that's kind of where 163J is. That's some background on it. So what's going on with it? So like I said, 30% of adjusted taxable income. The CARES Act came out and gave us some relief on that and bumped that 30% to 50% for 2020, 2021. So that's great. We have that benefit for this year. Next year, 2022, that goes back to 30%, right? And then what also happens in 2022 is the ability to add back depreciation goes away. So adjusted taxable income is no longer EBITDA anymore. It's just income plus your interest. So we're going to see potential interest deduction limitations. We're going to see very likely a need for dealerships to have to take advantage of the floor plan interest exception, which will knock them out of the ability to use the 100% bonus depreciation under 168K. So, that could be a problem for 2022. That's something that you need to kind of keep in the back of your mind and make sure you're thinking about, especially if you've got, a capital improvement or something that's near completion. Can we get this done before the end of the year so that you can take advantage of bonus depreciation in 2021, with the higher income levels that all the dealers are experiencing? All right, that's enough about 163J. I mentioned bonus depreciation. That's section 168K. Been around for a long time. It's bounced around. It was 30%. It was 50%. It was 100%. It's still 100%, but that does start to phase out. If you get into the next slide, you can see in 2022 we get 100%, but after 2022 it starts to drop down by 20% per year. Then by 2027 there is no more bonus depreciation. So there are other provisions of the code that allow for immediate expensing. Section 179 is still an option, and also you could use Section 179 as a mechanism for expensing. It's $1 million adjusted for inflation. I don't know exactly what the number is, but it's close. It's probably 1.1 million for this year that you can write off 100% under Section 179, and there's no issue with taking the floor plan interest exception under 163J and also taking Section 179. All right, I think that's it for phase outs. You want to talk about beta, or you want people to continue to listen to me talk, Lou?
No, I mean, go ahead, because this one's quick as well, and we're basically past the point, right, for 2021, right?
Yeah, I mean, so this was passed last year. So if you made money last year, you should know about this, because there was a lot of scrambling. There were a lot of late tax returns while New Jersey figured out how that should actually be accounted for and reported. But basically what this is, it's a state tax, New Jersey state tax that you pay at the entity level. Gives you a deduction against your federal taxable income. So your K1 shows lower federal taxable income than your New Jersey K1 does, because of that number. And it also generates a credit that you get to claim on your New Jersey return so that you don't have to pay the tax twice. That's kind of it in a nutshell.
Everybody's familiar with this at this point, right, Brian?
Yeah, I mean, they give you until March 15th to make the election or to revoke the election. But, you know, there's, I guess the important part is the guidance that came out from the IRS last year on this and other pass-through entity taxes, all these SALT workaround taxes, was the IRS basically came to this conclusion that to be deductible, they have to be paid. It doesn't matter if you're an accrual basis taxpayer or not, right? Because under typical accrual accounting rules, as long as you are, as long as you pay it within a certain period of time of year end, and it's a fixed liability and you can estimate it reasonably, you get the deduction. That's normal accrual rules. The IRS basically said you got to pay it before year end. So to make the payments, you have to make the election. So most people have made their elections for 2021 already, and hopefully have made payments or are preparing to make payments before the end of the year. Very important to get the payments in before the end of the year. I mean, I think you could make a position that if it's accrued, it's deductible, but you know, a lot of people smarter than me have looked at the guidance issued by the IRS and have concluded that the safe bet is to pay it before the end of the year rather than to challenge it. So we are recommending everybody makes their Bay payments before December 31st.
Okay, we're coming down the home stretch here. You know, unfortunately, Brian, a lot of my screen is blocked by our two pictures, so I'm going to let you talk about this one as well.
Okay, yeah, I mean, so there's not a ton to say on this, and there will be more to come, right? I think the Biden administration is very pro alternative energy. I think they're looking to provide for a lot of different tax credits to incentivize individuals, businesses, everybody to stop using fossil fuels and start looking for ways to do things like, you know, use solar or, you know, change over to electric vehicles. So we're not, you know, which seems to be kind of a trend. So this credit's been around for a little while. This is basically the EV charging station credit. I don't remember the form number off the top of my head, but it can be up to $30,000 per location. So it's not per entity, it's per location. So if you're, you know, single entity, you have a couple different locations, you can potentially get, you know, $60,000 of credits. You just need to kind of monitor how you account for this. The other thing, if you hop to the next slide, Lou. So New Jersey doesn't provide any kind of tax credit for this, but there are these grant programs out there, and I'm by no means an expert in these grant programs, but we actually, NJ Carr has done presentations on this stuff in the past, so you should be familiar with it. Pays to Plug In is a grant that's available from the state of New Jersey. Check it out before you commit, before you start installing things, because the grants will pay for things, but they won't pay for them after you've already paid for them and installed them. So it's very important that you look into this stuff before you start installing EV charging stations. You know, I think the kind of the takeaway here is there are credits out there. Make sure you're aware of them. Make sure you're telling your accountant when you install EV charging infrastructure, charging stations, electric vehicles, solar, all that kind of stuff. Very important because there are tax credits available. You just got to make sure that you're telling your accountant so we know to claim the credits on the tax return.
Again, a lot of people have been burned by this because they have not applied for their grants ahead of time. So this is not a retroactive grant, as Brian pointed out. You have to apply before you start with any shovel in the ground. So that's a key point to be taken away from today. What else do we want to think about, Brian, as we finish?
Yeah, so this didn't make it to the cover sheet of items that we were going to discuss today, but I thought, you know, there were just kind of a handful of tax planning considerations. And the first thing, I think it's a conversation I always have, at least when we're facing, you know, all this potential change to tax rates and new legislation and all this stuff, and the very strong likelihood of tax rates going up. how much tax planning do we really want to do? Like, do we really care all that much about deferring revenue and accelerating expenses and doing a lot of these things to mitigate our current year tax liability when we could be paying taxes at, 5, 6, 7, 10% higher rate next year? It's just something to consider. Ultimately, I end up trying to save taxes this year anyway, because there just is so much uncertainty right now with, who knows if the bill's ever going to get passed. At some point, something will get passed, but nobody can seem to agree on anything. So anyway, let's talk about some of the ideas that we typically throw out there. I mentioned this before about finishing up any capital improvement type projects that you've got going on. Make sure you're keeping in the back of your mind, or your accountant's keeping in the back of mind, the potential impact that the timing of completion of these things can have on your ability to take bonus depreciation, and how that ties into your ability to deduct interest expense. It's important. It's all timing differences, but it's still important. Rental fleet additions or loaner cars, to the extent you can get your hands on them, put them in service. Accelerated depreciation on those rental cars and loaner cars, certainly a nice way to pick up a temporary tax deduction, right? I mean, we turn these over annually or every 18 months, so it's a short-term deferral, but it's a deferral nonetheless. I think we've beaten up LIFO enough, though I'm always happy to take questions on it. Excess cash. So I did mention earlier, everybody got PPP money. Everybody is hopefully seeing much higher grosses. There's no inventory, so there's no floor plan. So you can't put all your cash in a CMA account. What are you doing with your excess cash? Are you, paying down high interest rate debt? Can't imagine that there's any high interest rate debt floating out there, but there could be. That's something that should be, taken off the balance sheet, taken out, because there's no reason to be paying high interest debt when you can't earn more than 1 or 2% on your money market account. Any other option, investment advisor, right? Talk to somebody. Everybody has a personal broker. There are advisors out there, fiduciaries that are very can design an investment strategy that has a very low risk and relatively acceptable rate of return. That just letting the cash sit on the sidelines is not. I know it's not a tax planning strategy, but at the end of the day, we're trying to save taxes so that we can save cash. And if you've already got cash, it should be working for you. Defer revenue, I mentioned that. Accelerating or prepaying some expenses, things like prepaying your insurance and using a recurring item exception to be able to deduct that. There's some ideas there. We talked about tax credits. This is more of a summary slide. Cost segregation studies. If you're not doing it, you're probably leaving some money on the table in the form of accelerated depreciation on some of the improvements you're making, or especially if you've acquired a new dealership. I mean, it's almost a no-brainer. The timing difference of taking some of that stuff over 39 years versus being able to expense it immediately under bonus depreciation. Employee benefits. So, with the environment we're in and how hard it is to attract, retain great employees, if you've got great employees, this is an opportunity to take some of that income that you've earned and reward them, right? So do you have a 401k with a profit sharing component to it where you could, put in a large profit sharing contribution? Employees appreciate stuff like that. There's, I think it was the CARES Act. I can't remember 100% for sure, but they changed the rules on employee student loan repayments. So if you have, employees that have student loans, you can pay off a portion of their student loans. It's tax-free to them. It's a tax deduction to you. It's a win-win, right? To do some other things. Donor advised funds, charitable lead annuity trusts. These are more on the individual side, tax planning vehicles, or, basically this is, we talk about this with our more charitable minded clients. And a donor advised fund is kind of a small version of a private foundation. Allows you to kind of front load a contribution if you have a year when you have significant ordinary income and you want to, you give $100,000 a year to a charity, you put $500,000 into the donor advised fund, you can offset your ordinary income in that year with it. The donor advised fund still makes the $100,000 contributions every year to the charity of your choice. Charitable lead annuity trust is just a more sophisticated vehicle for that, and it kind of wraps it in with a little bit of estate planning. So what it allows you to do is fund this charitable lead annuity trust in year one. So if you have, again, a year where you have significant ordinary income, like 2021, you could, let's say you give $100,000 a year, and you want to fund a charitable lead annuity trust. If you would, let's say, put $2 million into a CLAT, right? You would get a $2 million. It would be a 23-year term on the CLAT with a 5% payout. So it pays 5% per year for the next 23 years. That all goes to charity. The assets that are in the CLAT get invested. Presumably, you could earn more than 5%, but even if you only earn 5%, at the end of the term of the CLAT, there's still $2 million in the trust. That $2 million goes to beneficiaries, right? So, and there's a discounting calculation to determine the value of any gifting associated with funding a CLAT. So this 23-year term at 5% generally leads to zero taxable gift. So you get a $2 million charitable contribution deduction, there's no gift, and you end up getting $2 million out to your beneficiaries. It's not all good news. It's a grantor type trust. So the income that's generated in the trust does get taxed to you. So over that 23-year period, you're going to end up paying tax on the $2 million of income. So that's the downside, but that also gets $2 million more out of your estate. So all good from an estate planning perspective, assuming none of the discussions around eliminating the benefits of grantor trusts ever come to fruition. This is a viable option. Qualified opportunity zone investment deadline. I just threw this on here. This was another Tax Cuts and Jobs Act thing, and this basically says you could take a gain that you've realized from basically anything, selling stocks, selling your dealership, selling something, and you could roll the gain into what's known as a qualified opportunity zone fund or business or investment. And if you sit on that qualified opportunity zone investment for 5 years, you get, I think it's a 10% haircut on the gain. So if you have $1 million gain, now your gain's $900,000. The reason December 31st, 2021 is important is because December 2026 is the year you have to pay the tax. So that's the year, or you have to realize the gain. So if you don't get it in before the end of this year, there's no way to hold it for 5 years before triggering the gain. So you have to get it in now to be able to get that 10% haircut. There are other benefits of investing in qualified opportunity zones. For instance, if you hold your qualified opportunity zone investment, the gain on that investment is tax-free. So there are some opportunities there, but I didn't want to let that go because it is sort of a deadline that's expiring, and it's an opportunity that goes away permanently in a little over 2 weeks. I threw residency planning on there. Obviously, you can't move your dealership from New Jersey to Florida very easily, but
in the next 2 weeks.
In the next 2 weeks, but in just looking forward, something you always want to consider is there a way to kind of mitigate tax liabilities by being a resident of another state? Whether the dealership's a New Jersey dealership, it's always the income from the dealership will always be taxed in New Jersey. But if you're earning other sources of income and you're not tied to being in New Jersey and you're considering moving to a tax-friendly jurisdiction, that's certainly not a bad move. Especially if there's retirement money coming out. You want to wrap us up with a conclusion, Lou? I'm getting tired of talking.
Well, I'll tell you, we certainly covered a lot today. looking at this, there's a lot for people to think about. Talk about crucial in the next few years. I mean, crucial in the next few weeks. But we really have to monitor and see what's going on with the legislation, see what comes to light. I don't know what's going to happen in the Senate, as Brian pointed out. It may get stalled there, but we did talk about some of the provisions that might be likely at this point. And as with all of the items that Brian mentioned, including the charging station, it's good to take advantage of anything that you can. So, when we go back over this list that we went through in detail, there are some things to be considered, some things to talk to your accountants about, running scenarios for your particular situation, making sure that it would be beneficial to you. So again, we covered a lot here. I can't believe that you'd have any questions on what we covered, but I'm sure you do. And before we take any questions, Brian or I can be reached at our emails, or you can call us direct. We would be glad to answer any questions that you have anytime. So with that, Brian Hughes, do we have any questions that you want to get into?
Not right yet, but let's give everybody, if anybody does have any questions they want to address right now, please enter them into the questions tab. While Lou and Brian, let's give everybody a minute to do that. While they're doing that, if they have any, I know everything you guys spoke about is important, but if you had to pick one thing that you want participants to take away from this past hour, if they remember nothing else, do you want to pick one thing that they absolutely should take away from this?
Well, I would say, sticking with Jim's original premise, you really should think about what's going on with your life situation. What we talked about several slides back. If at all possible, if you can get your tissues lined up for any vehicles that are in transit as of December 31st, that would be great. Anything to increase your inventory up a little bit by the end of the year. Those vehicles in transit can help a little bit. That's something that you might want to look at. Brian, what would your choice be? Brian Wallace.
I would say just make sure you are keeping your tax advisors informed, right? I mean, any special situations, that would be my, that would be my takeaway. Make sure you're sitting down, on a regular basis, having conversations, talking about what's going on at your dealership, asking questions about what's new legislatively, and what you're planning. I mean, I think that's important.
And did we mention that meals are 100% deductible this year, Brian?
Lou, I appreciate you adding that on the end here. I was trying to work that in while you were doing the conclusion. I was looking at my notes and I said, I knew I was going to forget to say something about meals being 100% deductible, and sure enough, I did. Meals from a restaurant, 100% deductible.
Well, you guys must you must be good, because either you've overwhelmed everybody and they have too many questions to submit, or they don't have any questions. But as they said, if you have any questions afterwards, please contact Lou or Brian at the numbers or emails you see on the screen. We will, for those of you who joined a little late, we are going to have a recording of this webinar as well as the slides posted on the NJCAR website, either later this afternoon, no later than first thing tomorrow morning. So thank you to Brian and Lou. Thank you to all the participants. And thanks again. That concludes today's webinar. Have a great holiday and stay safe.
Thanks, Brian.
Thanks, Brian. A lot.